Welcome to the Daily Drawdown, where rates, retail, and AI capex are moving the tape. The big shift right now is simple. Long-end rates are rising while consumer demand is getting more selective, and that combination raises the bar for almost every earnings story. At the same time, AI spending is still broadening, but the trade is getting more crowded, more political, and more expensive to fund. Start with the macro pressure point. The long end is doing the damage. The 30-year Treasury auction cleared at the highest borrowing cost in about 25 years, with the 30-year yield around 5.25%, and the curve has steepened as the front-end prices less Fed tightening while the long-end prices inflation, issuance, and duration risk. Why it matters is straightforward. If the 10-year pushes toward 5%, equity valuations get squeezed, housing stays pinned, and big capex stories have to answer harder questions about financing strength. That risk is bigger because Treasury supply, corporate borrowing, and fiscal deficits are all leaning the same way. Fed language still matters, but supply-demand in the long end matters just as much now. The consumer is slowing at the margin, but unevenly. July retail sales fell about 0.5%, the first monthly drop in roughly 9 months, and Michigan sentiment slipped to 51 from 55.2. Some of that is timing noise from Prime Day moving into June, but the broader message is still softer demand and weaker mood. The useful read is the K-shape. Higher income households and retirees are still spending, especially on travel and differentiated goods. Lower income shoppers are trading down into basics, value chains, and cheaper brands, while bigger ticket home-related purchases stay weak. For stocks, that means Walmart still looks durable, but not immune, especially if some good news is already priced in. Target is more of an execution story with high expectations after a huge run, so even a small profit miss could hit the stock. In off-price, Ross has taken share, while TJX still has the blue chip label. Housing is still trapped by mortgage rate lock-in. Homeowners sitting on ultra-low mortgages are not moving, which suppresses existing home sales and even foreclosures. Analysts expect mortgage rates to spend much of the year in the upper sixes, with 7% still very possible if inflation or geopolitics flare. There is one slightly better live read. Pending home sale contracts are up about 3.5% year to date, which suggests some organic demand is still getting through even with rates high. For Home Depot and Lowe's, the setup is still tough because home sale velocity is weak and financing costs are high. Home Depot may hold up better because it has much larger exposure to professional contractors than Lowe's, but plenty of investors still want no part of either name ahead of earnings. The strongest secular story remains AI infrastructure, but it is no longer just a chip story. CapEx is spreading into memory, storage, power, cooling, electrical gear, construction, cloud, and industrial materials. On-air estimates for hyperscaler spending have become enormous, with discussion of the top 4 moving from roughly $750 billion toward $1.2 trillion. That supports the bullish case for memory names like Micron and SanDisk, which are being treated less like pure commodity cycles, and more like longer-duration AI infrastructure exposure. NAND is getting more attention for inference and persistent memory use cases, where persistence matters more than DRAM. But this is also where risk is building. Semi-screen expensive on smooth valuation measures. Some bubble frameworks have been triggered, and if leadership in names like NVIDIA, TSMC, Broadcom, Micron, AMD, or ASML breaks technically, crowded positioning can unwind fast. The next constraint on AI is not demand. It is power, permits, and local politics. Opposition to new data centers is rising in places like New York and Texas, and moratoriums or restrictions may not stop buildouts outright, but they can raise cost and push developers toward bring-your-own-power models like dedicated generation and behind-the-meter setups. That matters because it shifts more capex into energy and infrastructure and turns AI deployment into a more contested local policy issue. This is the early version of a broader AI regulatory problem, from siting and power to licensing and labor concerns. On the software side, the market is getting stricter about what counts as real AI value. OpenAI told investors enterprise revenue has now surpassed consumer revenue, which is a meaningful shift toward applications and coding use cases that companies will actually pay for. Management also said newer models are materially more efficient on agentic coding tasks. The opportunity is clear, but leadership turnover and unanswered margin questions still matter, especially with IPO exploration in the background. For public software, this has become a stock picker market. AI exposure alone is not enough. The winners are the companies actually monetizing AI into workflows, and takeover interest in beaten-down names helps put a floor under parts of the group. Under the surface, market breadth has improved, with the Russell 2000 reaching all-time highs, but the debate is whether this is true rotation or just the same AI factor hitting different tickers. The cleaner approach from strategists is a barbell. Keep core tech and AI exposure, but add small-cap value, healthcare, materials, biotech, and selected international exposure to reduce concentration risk. In options, retail investors have mostly leaned into volatility rather than fleeing it, while institutions are still seeing elevated single-stock call premiums in parts of the S&P. That is keeping covered call strategies attractive when volatility spikes. A few faster hits. Prediction markets are facing a serious legal squeeze from states and federal regulators, and the core question is whether these products are gambling or federally regulated derivatives. That uncertainty could materially narrow the market. In defense, drone tariffs and the Ukraine lesson set keep pushing procurement toward cheap drones, counter-drone systems, and automation in the industrial base. The bottleneck is less demand than whether governments will give contractors long-term commitments. In energy, Europe faces a tighter winter gas setup. U.S. LNG exports keep pulling supply outward, and capacity-constrained businesses like refining still look more interesting than a pure bet on crude. And in healthcare, AI is moving from search to action. Tools like Gemini linking into ZocDoc show how agents can go from symptom lookup to booking an in-network doctor, which could reshape healthcare discovery and distribution. That is the setup: higher capital costs, a selective consumer, and an AI buildout that is still powerful but no longer frictionless. This has been the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.